Welcome back, everyone. Intuit is a company that I've followed for years now looking for an entry. The market has finally given us an opportunity as it sold off 35% over the past year and roughly the same amount year to date. Investors believe that AI is on its way to disrupt Intuit's market position. I am of the belief that Intuit will be a great beneficiary of AI overall. They've carved out an entrenched position between small and mid-sized businesses as well as consumers alike, and they will further use AI to leverage their proprietary data as well as their strong market position in small business accounting and taxes. I believe Intuit is a true compounding machine sitting in plain sight that's now being sold off at a significant discount. So let's go over my case for Intuit and why I'm investing into the company recently. Let's start off here with the business model. Intuit is broken up into 4 business segments. The first one being Global Business Solutions, which is roughly 59% of the revenue as of this year. This segment serves small and mid-market businesses and accounting professionals who advise and assist them. QuickBooks and their Enterprise Suite offer an all-in-one business platform which includes financial management services, human capital management solutions such as payroll and time tracking, money solutions such as merchant payment processing, bill pay, checking accounts through an FDIC member bank partner, and financing for small and mid-market businesses. Intuit Enterprise Suite provides mid-market businesses with a configurable AI-powered solution that includes multi-entity and multi-dimensional financial management capabilities designed to seamlessly scale and enhance productivity and profitability for more complex businesses to streamline operations. MailChimp offerings include marketing automation and customer relationship tools. This business segment is basically just QuickBooks and MailChimp. They combined them together recently, and it is by far the biggest part of the business, and it is still growing very fast at roughly 16% per year. Their next business segment is consumer, which is 25% of the revenue roughly. This segment helps customers get their taxes done with confidence, whether they do it themselves or with the help of an AI-enabled human expert. TurboTax delivers do-it-yourself and assisted income tax preparation products and services sold in the United States and Canada. This business segment is just TurboTax, which is aimed at helping consumers get their annual taxes done yearly. The next business segment we have is Credit Karma, which is roughly 12% of revenues. This segment serves consumers with a personal finance offering that helps members find the right financial products and make smarter money decisions throughout the year to reach their financial goals. This includes personalized recommendations for credit card, home, auto, and personal loan and insurance products, online savings and checking accounts through an FDIC member bank partner, and access to their credit scores and reports, credit and identity monitoring, credit report dispute, credit building tools, and tools to help understand net worth and make financial progress. Credit Karma was a recent acquisition of the company and has taken off like a rocket, especially over the past year, and has further entrenched their overall network of products. Their last business segment is ProTax. It's very small, roughly 4% of the revenue, and it's slow growing. This will be the last time I talk about it. But this segment serves professional accountants who are essential to both business success and tax preparation and filing. Moving on to the most important part of this, which is competitive advantages. To start off, they benefit from a monopolistic market share. QuickBooks owns roughly 84% of the small to mid-sized business market share in the United States. TurboTax holds roughly 60% of the consumer tax returns market in the United States. And Credit Karma holds roughly 21% of the consumer financial comparison market in the United States. Especially with QuickBooks and TurboTax, they're the biggest player in their market. That means they have the most data, most scale, most reach, and the most pricing power within the segment if they can continue to hold that giant market share. Next up, Intuit benefits from network effects. Intuit has integrated QuickBooks with MailChimp, TurboTax, and Credit Karma, creating a self-reinforcing ecosystem. Business owners can use MailChimp to advertise their business through emails, text messages, and social media. They can also use Credit Karma to give customers financing options via large invoices, as well as sync employee paychecks to Credit Karma Money. Lastly, they can streamline tax filing with TurboTax from QuickBooks or from Credit Karma for individuals or small businesses to have most of your return filled out automatically within the ecosystem. So basically, all of their products they're all separate, but they all are in one ecosystem and they all benefit each other. Sure, some consumers will only use one, but there are a lot of consumers or businesses that will use multiple or all 4 of Intuit's offerings. For example, say you're a small business with roughly 50 customers. You're going to use MailChimp for advertising, for automated texts. Say you have a service business, you're going to automate text whenever you're coming out to certain locations and certain customers. Then you can have your employees sync up with Credit Karma Money, which is basically a free personal finance system that helps consumers with money decisions, finding credit cards, etc., as well as opening high yield and checking accounts. Or if you're one of the small business owners on QuickBooks, They will have a lot of your data from those platforms, and they can integrate it straight into TurboTax when it's tax season and have a lot of your filing done before you even get started. This overall creates one big sticky network that has high retention rates between all of the business segments. Next is switching cost. Intuit benefits from switching costs with QuickBooks, considering the fact that they hold years of company information, including employee, customer, inventory, and tax information. It would cost lots of money and time to uproot their business operations and transition into a different system and manually transport all of their data over to a new network. TurboTax also benefits from switching costs due to the fact that they hold all of your previous tax returns done with them, and they automatically have a good portion of your return done each year taking information from your previous tax return. These switching costs, especially with QuickBooks, are very, very sticky. These businesses, small to and medium size, they all operate on QuickBooks. They're vital for their daily operation. And for them to uproot their whole system, all of their information, and move it to a competitor, it would have to be a much, much, much cheaper or better offering, which QuickBooks is continually investing into their platform to make sure they have the best offering on the market, as well as solid pricing. Lastly, brand power. Intuit is the trusted name for decades now in the US for small business accounting and for tax filing, which are two very sensitive and crucial subjects for individuals and small businesses. I'm of the belief that brand power is one of the weaker moats, but for something very crucial like taxes or proprietary data within a business, I believe that brand power does have some weight here. Next up, let's cover pricing power for Intuit. Intuit has definitive pricing power, especially in their QuickBooks business segment, as they own nearly the entire market. This allows them to gradually increase prices over time at a higher rate than inflation, as well as implement new products and upsell offerings by adding incremental value to their customers. They also have some pricing power in TurboTax as they take advantage of the switching costs from users combined with their leading market share. Pricing power is very important because this can really cause explosive growth within the free cash flow and net income of a business over time. If inflation is at 3% and you can increase prices on average every year at 5% without losing market share, without losing customers, you will have insane growth even if you don't grow that fast. Next up is organic growth. Intuit has an extremely long runway of growth. As their small businesses and their ecosystem grow, they will likely maintain their business and be able to upsell while continually gaining new startup businesses over time, allowing them to also grow in size. This, connected with their overall network, will provide organic growth within all of their business segments over the coming decade or more. Organic growth is very crucial because if you're maxed out on organic growth opportunities, you will continually have to reinvest into new opportunities, or you simply won't be able to grow the overall revenues, free cash flow, and earnings per share of the business, therefore stalling out growth over time. Intuit has long ways of growth. Roughly 90% of their overall revenues come from the United States, so they can grow internationally as well as in the United States. They still have plenty of room to grow without entering new lines of business that can cause risk. Next up, high returns on capital. This is very important. Intuit has routinely earned solid returns on capital historically, considering they have high margins and a lot of avenues of reinvestment. I am more than confident in their ability to continue generating ROCE above 20% for the coming years. Over the recent years, they've been around 20, 30, sometimes they dipped into the teens percent of return on capital employed, and I believe this is going to stay the same way going to the future. I could see this even ramping up to 30% with the integration of AI capabilities within their network. Next up, let's go over the management. I want to go over the direction of the business. Intuit is aggressively moving into the direction of an AI-driven expert financial platform for businesses, consumers, and accountants alike. They plan on leveraging their data, human expertise, and AI capabilities to continue providing the best value in the market to their customer base. They also have plans of expanding more internationally, as over 90% of their revenues come from within the United States. This is the direction that management themselves has described that they're heading in, and I believe all of these avenues are great and predictable for the future of the company. Next up, capital allocation. Management has been a great capital allocator over the past decade. They have had successful small and large acquisitions without overpaying, including MailChimp and Credit Karma within the past decade. They have also continually held a conservative balance sheet and performed regular dividend payments as well as share repurchases, returning capital to shareholders efficiently. Management has maintained the status of investing into growth where they see fit and returning any leftover capital back to the shareholders over time. This is very important. We don't have management doing anything that's far out in left field, out of nowhere, that we didn't see coming, that are really questionable for what returns on capital they will have, as well as if they have extra capital, which they regularly do, they are giving it back to shareholders via share buybacks and dividends over time. Lastly, let's go over the valuation. For the trailing ratios, we're looking at a 27 price to earnings, a 5.85% free cash flow yield, which is 4% after their dilution, a 5.7 price to sales, which is not bad at all for a high margin software company, and an 18 enterprise value to free cash flow, which is very solid. For the trailing growth, we're looking at 5-year revenue growth of 20% annually, give or take, 5-year EPS growth of 14.5% annually, and 5-year free cash flow per share growth of 19% annually. For my expectations, I believe that the company will continue to see rapid growth in revenue, free cash flow, and earnings per share, resulting in a 5+ year window of free cash flow per share growth of 12% on the low end and 20% of the high end. Assuming we hit right in the middle with this 16% free cash flow per share growth over the coming 5 years, we will see $47.68 in free cash flow per share for the year 2030. That would give us a free cash flow yield on cost from today's price of 12.2% in 2030. 10 years of that growth, and we would be at a 25.7% free cash flow yield on cost. And 20 years out, we're looking at a 113% free cash flow yield on cost if we maintain that 16% per year growth. Let's hop over to Qualtrim. I want to show you a few things here. First off, the dividends. Anyone looking for a great dividend stock, look at this chart. Since 2012, the dividends have grown pretty much in line every year, growing about 15% per year for the past 10 years, 5 years, 2 years, and 1 year. I expect this to continue as their payout ratio isn't that bad. It's 29.9%, so 30% of free cash flows are going to dividends. As well as you have the return of capital here. They're actually spending more on stock repurchases, over double in the last quarter, or the last trailing 12 months. We also have cash to debt, not too bad here. A little bit more debt than cash, but $5.3 billion in cash with free cash flow over the past trailing 12 months, over $6 billion, not a problem at all. Then let's look at the valuation here. Historically, we're looking at, let's do 10 years, price to free cash flow yield. We're roughly around 6 right now. On average, we're trading around the 3% mark. It even got as low as 1.75 here in 2021 when it traded way up. So it's regularly trading between 2.5 and 3.5. So let's use that in our exercise here. Let's go ahead and do a bear base and bull case for Intuit over the coming 5 years. Let's do our bear case first. If we see the 12% growth and we trade at a cheap valuation of 3.5, which is once again on the high end for this company, we're looking at 24% returns. Let's do a base case of 16% and a 3 yield. That puts us at a 32.5% annual return. Stock price in 5 years would be 1.6 thousand. And if we go up to the 20% per share growth in free cash flow, and we trade down to a 2.5 free cash flow yield, we're getting 42.2% annual returns on the stock price. 5 years from now, we're looking at $2,270 per share for Intuit, now trading under $400. I simply have to buy the stock. Once again, here's Intuit here at the start of the year. We were trading at $630-ish. We got as low as $350, I believe, just 2 or 3 days ago. We're trading up a little bit. It was at $400 earlier today. Now it's roughly $391. I started adding around $400. I'm up to 5 shares now. I plan on adding. They do report earnings after the bell tonight, so I could definitely see this one rebound. I'm hoping there's some kind of hiccup in this quarter that allows me to buy shares closer to $350, maybe even down closer to $300 per share, which would be egregious for this company. I'm not scared about AI. I don't think people are going to trust non-specialized agents with proprietary data such as taxes, business operations, employee information, customer information, and other stuff that Intuit has had their hands in over the past decade or two. I expect this company to be business as usual, and I could see them accelerate growth. As you can see here, revenue over the past 1 year is actually faster than it has been over the past 2 years. So we're seeing a re-acceleration in revenue growth. If this happens, this company is going to have such great returns from this price point. I basically have to buy the stock at this point. There's a lot of software names out there, but I believe Intuit is one of the most insulated in the entire market. More than Salesforce, more than ServiceNow, maybe more than Adobe. That's why it's slightly more expensive than something like Adobe. But I mean, 16 forward PE, roughly 6 free cash flow yield, 4% after dilution. With a company of this quality, I pretty much have to buy shares. Let me know what you guys are doing with Intuit below. Don't forget to like and subscribe on the way out, and thank you. Have a good day.